Right now, millions of investors are looking at SpaceX, ticker symbol SPCX, and seeing what feels like the financial opportunity of a lifetime. The mainstream headlines are screaming about a revolution in the stars. The social media euphoria has reached an absolute fever pitch, and every group chat you are a part of is likely buzzing with the exact same frantic thought: I need to get in right now, before this stock takes off without me. But here is the dangerous truth that the financial media isn't telling you: smart money is doing the exact opposite of what you're planning to do. While the internet celebrates this listing as the undisputed next Tesla, the most sophisticated institutional players on Wall Street are quietly preparing for a different outcome. They are not planning to hold this stock for the long haul at these astronomical price levels. Instead, they have engineered a highly sophisticated liquidity trap. If your decision to buy SpaceX stock today is based on cinematic rocket launches and the romantic dream of colonizing Mars, I have a harsh reality check for you: you are not arriving early to a technological revolution. You are arriving exactly on time to serve as someone else's exit strategy. Today, we are stripping away the smoke, the mirrors, and the retail frenzy to expose the brutal financial machinery that makes the $1.75 trillion SpaceX IPO one of the most dangerous minefields in modern market history. If you're finding value in this data-driven analysis, please take a brief second to like, subscribe, and share the video. It directly supports our growth, while keeping you equipped with the critical insights needed to navigate these markets safely. Before we begin unpacking the brutal mathematical realities that the Wall Street hype machine is so desperately trying to ignore, let's clearly establish what this video is, and more importantly, what it absolutely isn't. This is not a video attempting to tell you that SpaceX is a fundamentally flawed company. By almost every conceivable operational metric, what Elon Musk and his engineering teams have constructed is nothing short of a generational triumph. They currently launch more mass into Earth's orbit than entire sovereign nations and their state-funded space programs combined. Their Starlink satellite constellation has successfully blanketed the globe. The engineering works brilliantly. But this analysis is about something far more vital to the survival of your personal bank account: the massive, incredibly dangerous gap between a phenomenal company and a phenomenal investment at a specific valuation. Those two concepts are not remotely the same thing. Historically, when retail investors allow emotional excitement to blind them to the realities of sound financial valuation, they don't just experience underperformance, they get absolutely crushed. We are here to ensure you don't become collateral damage in Wall Street's biggest payday. To understand exactly why buying into a heavily hyped IPO like SpaceX is so inherently dangerous, you have to look past the opening bell and understand how the capital machinery actually operates behind closed doors. Most everyday investors labor under the illusion that an IPO is a massive, democratic celebration where everyone gets a fair slice at the same price. In reality, the modern IPO is a highly coordinated, multi-stage relay race, and by the time the starting pistol fires for the public, you have already been positioned as the very last runner. Think deeply about the pricing structure. The official IPO price was meticulously negotiated behind closed doors by lead underwriting banks strictly for the benefit of their preferred institutional clients. By the time that SPCX ticker finally hits your mobile brokerage app, the smart money has already secured their massive allocations. Now, the financial media is making a tremendous fuss over democratization by steering shares toward retail apps. Pattern interrupt: host leans in closer. Do not let Wall Street's sudden display of retail generosity fool you. This isn't charity, it is a calculated mechanism for generating unparalleled market volume. You are not buying at the ground floor, you are buying at the absolute ceiling that the insiders explicitly built for you to crash into. Let's pull back the curtain and look at the actual business using the unvarnished data from the company's official S-1 financial filings. In 2025, SpaceX brought in roughly $18.7 billion in revenue. By any standard, that is a massive business. But here is the critical detail: in that exact same year, the company posted a staggering net loss of nearly $5 billion. They are incinerating cash at a historic rate. And when you look at the recent data, the cash burn is actually accelerating, heavily driven by the massive capital requirements of absorbing Elon Musk's XAI division and the endless compute war for AI infrastructure. When you dig deeper into the unit economics, the narrative gets even more complicated. The vast majority of the public believes they are investing in a futuristic, interplanetary rocket company. But the launch vehicles are no longer the primary economic engine. The real heavy lifter is Starlink, making up roughly 61% of all corporate revenue. Therefore, when you buy a share of SPCX, you are not buying a diversified space portfolio. You are buying exactly one profitable engine, Starlink, that has been structurally tasked with towing a remarkably heavy, money-losing train of experimental divisions behind it. Let us contextualize exactly how absurd this pricing truly is. At a valuation of $1.75 trillion, SpaceX instantly becomes one of the most expensive entities on planet Earth. At these levels, you are paying a price-to-sales multiple of roughly 94. Let me translate that into human terms. You are willingly handing over $94 of your hard-earned capital for every one single dollar of top-line revenue this company generates. Not profit, just sales. To put that into perspective, the most dominant technology giants in the world, the Apples and Nvidias, typically trade at revenue multiples in the low to mid-double digits. Paying 94 times sales for an enterprise that is deeply net unprofitable is an anomaly that borders on financial fiction. Rigorous research suggests that the true intrinsic value sits closer to $780 billion. That means at the current price, you are paying a massive 55% hype tax. You are paying for a utopian story about the distant future, priced as if flawless execution over the next decade is already a mathematical certainty. The peril of this IPO does not stop with overvaluation. There is a secondary trap embedded in the market's architecture: forced institutional buying. Shortly after a megacap company of this size goes public, massive passive index funds, the ones that manage your 401ks and pensions, are mechanically forced to buy billions of dollars of the newly listed shares. These funds do not employ analysts to ask if 94 times sales is a prudent investment. They are legally mandated to buy the stock regardless of the price. This creates an absolute illusion of safety. The price stays high because billions of dollars of price-insensitive money is flooding in. But beneath that surface, the original venture capitalists and early employees are simply biding their time, waiting for their lockup agreements to expire. The very second they are legally permitted to sell, they will utilize the massive liquidity provided by the index funds, and by retail investors like you, to quietly cash out their billions. Look at Rivian in 2021, it looked unstoppable on day one, then steadily collapsed by 67%. So, we must ask the ultimate question: what would it actually take for a long-term investment in SpaceX to make fundamental sense at these prices? To simply match the historically boring 10% annual return of a basic S&P 500 index fund, SpaceX's market cap would need to balloon to an incomprehensible $4.5 trillion exactly 10 years from today. To justify that price tag, they would need to generate well over $500 billion in annual revenue. To bridge that gap, SpaceX would be required to compound its growth at a staggering 41% every single year, for a full decade, without a single failed rocket launch, without a single satellite collision, and without a single global economic downturn. You aren't purchasing a stock at a fair price, you are paying upfront for an absolute financial miracle to occur. But there is a third, much more profitable path: absolute patience. Step away from the trading screen. Let the opening theater play out. Allow the massive waves of insider selling to finish. The stock market historically rewards patience far more reliably than it rewards blind speed. We built a proprietary expectations calculator inside the Wealth Logician's vault specifically designed to help you stress test these narratives yourself. But whether you utilize our tools or your own, never forget the golden rule: the story can be beautiful, but the math must always make sense. Are you buying the launch today and serving as someone else's exit liquidity, or are you waiting for the dust to settle? Let me know in the comments below, and I will see you in the next video.